Welcome back to the auditorium. We'll continue with the digital part of our discussions in a little bit different angle from the more practical point of view, how fiat money versus the distributed ledgers or decentralized finance is working from the legal perspective, from the technical perspective, generally speaking, how the payment system is evolving. We were talking about monetary policy and fiscal policy in the first part of our discussions, but the authorities should have control over those units of money to implement monetary policy. Otherwise, they may be dual life when some central banks or globally central banks are doing their job, but there's another life happening in parallel. And here the singleness of money, that concept of one legal tender is important consideration. They may have different faces, paper, fiat, or central bank digital currencies, or even some sort of private money, which is interchangeable. There is no closed systems, and the interoperability is working. And as I said, the monetary authorities have control over those systems. We will start from Rosa Lastra. She's professor of international financial and monetary law from Queen Mary University of London. She's a specialist of law, and this is a really interesting consideration how in the existing legal infrastructure, how may digital currencies and virtual assets and central bank digital, whatever you name it, may work, or the traditional legal system should experience some changes, some evolution or revolution maybe. Rosa, hello. We greet you from Dilijan.
Thank you. Can you hear me well?
Yes, it's perfect.
Wonderful. Okay, thank you very much. Let me start by also thanking Marcusan as Executive Director of the Reinventing Bretton Woods Committee and the Central Bank of Armenia for inviting me to this symposium. In my presentation, as you mentioned, I will be talking about the concept of monetary sovereignty and some legal hurdles to adopt CBDCs. Let me start by saying that while unbacked cryptocurrencies such as Bitcoin and stable coins are examples of private digital money, together actually with tokenized deposits or commercial bank digital money, central bank digital currencies, or CBDCs, are actually a manifestation of the power of the state in the provisions or issuance of money. And in this regard, CBDCs or will be a new form or manifestation of fiat money. Money is or becomes a public good. This means that the public authorities should have a role both in the issuance of private digital money, CBDCs, and as ultimate guarantors in the regulation and supervision of private digital money and the payment system associated with it. The Silicon Valley Bank crisis and the subsequent saga of banking troubles in 2023 evidence what in the FT was referred to, there are few libertarians in a financial foxhole, hence the role of the state. Charles Goodhart, my maestro, explains in his book, The Evolution of Central Banks, how competing banks had a natural tendency to centralize reserves, and how this competition and centralization of reserves led to the emergence of a central bank as a non-competitive, non-profit maximizing institution. Arguably, in the fintech universe, we can already observe a gravitation towards the center in the concept of stablecoins, which gravitate around fiat currency and safe assets. I was asked to talk about the legal framework of money. It's important to realize that the legal framework of money and central banking around the world, and I have doing research on central bank laws for 30 years, they were drafted before the digital revolution. Central bank laws therefore speak about coins, banknotes, and reserves, but they do not speak of digital currency, ledgers, tokens, DLT. In a paper I wrote with Jason Allen, which we entitled Lex Cryptographia Financiera, we confront some of these issues and we link the idea of code as law, borrowing from Lawrence Lessig's seminal contribution, the concept of embedded norms, with the medieval lex mercatoria, which was a non-state legal system which evolved within trading networks across the fragmented political geography of medieval Europe. Central banks, it should be pointed out, they were skeptical of virtual currencies till Libra arrived. Central banks had watched the arrival of Bitcoin as a niche experiment for exoteric libertarian techno-aficionados in California, or worse, for people involved in money laundering around the world. But at that time, they did not feel threatened. However, the announcement by Meta or Facebook, with its 2.9 billion users at the time, of a digital currency Libra, which then became Diem and was eventually discarded in 2022, was a turning point. Central banks, which had been reluctantly dragged into the digital provision of money, started experiencing the opposite, some form of FOMO, as my teenage children would used to say, the fear of missing out. And though they do not want to let the system of fiat money, independent central banks, personal monetary policy based on the reserves of the banking system, and financial stability derail because of virtual money and pseudo payments, they are aware that digitalization has reached the source of central banking. China and Sweden were first in their proposal or at an advanced stage of development. And around the world, 90 countries are exploring the introduction of CBDCs or have already launched CBDCs, like in Nigeria or Bahamas. What exactly are CBDCs? Though there is no commonly accepted definition, the BIS Committee on Payment and Market Infrastructure states that CBDCs is envisioned to be a new form of central bank money. That is a central bank liability denominated in an existing unit of account, which serves both as a medium of exchange and a store of value. We should point out, before going further into examples, that while digitalization has been changing payments for some time, digitalization is now also changing and challenging the concept of money. The ECB, the European Central Bank, published in 2020 a report on the digital euro, and the European Commission on the 28th of June unveiled a comprehensive legislative package that includes a proposed regulation on the establishment of the digital euro and also proposed regulation on the legal tender of euro banknotes and coins. This package sets the framework for the introduction of the digital euro as a complement to physical cash. In the United Kingdom, the Bank of England and His Majesty Treasury announced the creation of a task force in 2021 to explore CBDCs, though the House of Lords published in a very skeptical report entitled CBDCs, a solution in search of a problem, ? And then in April 2022, the UK announced plans that would recognize stable coins as a valid form of payment, and actually very recently, on the 29th of June, a new Financial Markets and Services Act was passed in the UK, classifying crypto as a regulated financial activity and stablecoins as a means of payments under existing law. Also in February 2023, HMT and the Bank of England published a digital pound consultation paper accompanied by a technology working paper by the Bank of England. So we have very clear proposals, legislative proposals on the table in the ECB, and a very serious attempt of advancing at the digital pound in the UK. What happens in the US? In the US, is a reluctant latecomer when it comes to CBDCs. No wonder, as I'm sure Harold James will remind us later, given the role of the US dollar as the established global currency and outmost reserve currency. But notwithstanding this reluctance, in March 2022, US President Biden signed an executive order requiring the government to assess the risks and benefits of creating potentially a digital dollar. And then in 2023, two stablecoin draft bills were published, one the Democratic Compromise draft and the other one a Republican bill to provide for the regulation of payment stablecoins and for other purposes. But they are still at the level of legislative proposals, not legislation. The motivation to adopt CBDCs in developing countries is different from developed countries. And in developing countries, financial inclusion and a desire to diminish their reliance on the US dollar and dollar reserves are a key consideration. Let me go a little bit more into some of the legal authority and competence to issue CBDCs, and then I will make some remarks on monetary sovereignty, and if time permits, on some international considerations from a legal perspective. The limits of the legal concept of money delineate the regulatory perimeters. For example, in 2018, the then president of the ECB, Mario Draghi, stated his position on the classification on virtual currencies. A Estonian proposal at that time for a CBDC, which was called Estcoin, had been deemed to be a new form of money and therefore inconsistent with the treaty for the functioning of the European Union, specifically Article 128. Privately issued virtual currencies were then dismissed as money candidates and were held to fall outside the remit of the ECB. What happened then is that regulation occurred at the national level, leading to a proliferation of regulations from Malta to France, all the member states of the European Union, with the potential for undesirable regulatory arbitrage. However, this situation is now partially being reversed with the adoption in May 2023 of MiCA. MiCA is the regulation of markets in crypto assets, which establishes a harmonized framework and a common supervisory architecture to both issuers and providers of crypto asset services, with many exceptions, including CBDCs. Coming back to CBDCs, a key question is, what's the legal mandate to issue CBDCs? And broadly speaking, the provisions authorizing a central bank to issue CBDCs, or those that already authorize central banks to issue notes, and those provide the basis for token-based CBDCs, and then the provisions in central bank laws that authorize the central bank to open account for their counterparties, currently only exclusively commercial banks or the counterparties at the central bank. So these will serve as the legal basis for account-based CBDCs. The IMF has conducted a study, and I contributed to that study, in which it says you can have also a new legal provision that authorizes the provision of CBDCs if you don't want to rely on existing law, and potentially the role of the central bank, the development tasks that the central bank does in many, for instance, emerging countries and developing countries, could also be used as a legal basis to authorize the issuance of CBDCs. Going back to the euro, which is interesting because that's the most clear legislative proposal to adopt a potential digital CBDC, a digital euro within established framework. It's interesting for those lawyers in the audience and those of you that are interested in the legal dimension that the digital euro shall be established in accordance with a regulation which is based on Article 133 of the treaty, and which is an interesting choice. Note issues should be pointed out is considered by the treaty to be part of the exclusive competence of the Union in the area of monetary policy for the member states whose currency is the euro. This is according to Article 3 and Article of the Treaty of the European Union, Article 128. Interestingly, also, the proposed regulation on a digital euro does not mention another article, which in my opinion, which has provided the basis for account-based CBDCs, and that Article 17 of the ESCB statute, which deals with accounts with the ECB and the NCBs. Moving from one legal issue to the other and conscious of time, let me move a little bit to legal tender, something which was already mentioned in the introduction. What's legal tender? Legal tender status is the power to validly and definitively extinguish monetary obligations, which must be accepted by the state as well as by private individuals as final settlement in any payment. So features of legal tender or mandatory acceptance: 1, 2, at full face value; 3, with the power to discharge payment obligations. The digital euro, according to the proposal, is to be granted legal tender status. Article 4 of such proposed regulation says the legal tender status of Eurobank notes and coins shall entail their mandatory acceptance at full values with the power to discharge from a payment obligation. And then Article 15 says Eurobank notes and coins, the physical manifestation of Eurobank notes and coins and the digital euro, shall be convertible into each other at par. It is very important and very interesting from those of you that are focusing on issues of this side. Let me move a little bit from the EU before I go back to the EU. Interestingly, the adoption of Bitcoin, which is, as we know, a private and backed cryptocurrency that is not backed as opposed to a stable coin, in El Salvador as legal tender, raises issues about the confluence between the private and the public domain in the provision of money. And it also provides a new gloss to the concept of legal tender, even though, in my opinion, cryptoization is unlikely to be dollarization, even in El Salvador. Moving from legal tender to other issues of design, a controversial issue in the proposed regulation for the establishment of the digital euro is that of holding limits. According to Article 16, there will be limits on the use of the digital euro as a store of value, including holding limits. Why this? The reason for doing this is financial stability, in line with another provision of the treaty, Article 127.5. But why? It's fear. It's the fear of disintermediation. It's the fear that the unrestricted use of the potential digital euro could have adverse effects on credit provision to the economy by credit institutions, and this disintermediation could also affect the profitability of commercial banks and the very conduct of monetary policy, which are since commercial banks are the ones that currently hold reserves at the ECB.
Excuse me, Rosa. Excuse me. Just for housekeeping matters, we'll for sure we'll come back to digital euro, and our next speaker is also will touch that, I'm sure. Let's elaborate the topic you're raising in a Q&A part. Yeah, just we are a little bit running out of our schedule. So if you have final ideas,
my final point
to conclude.
Monetary sovereignty. Monetary sovereignty is a particular attribute of the general sovereignty of the state under international law. And the concept of sovereignty is anchored in a territorial jurisdiction. And broadly speaking, a jurisdiction is a context in which some set of rules applies, and generally in which some institution is authorized by those rules to enforce them. Jurisdiction becomes very important when parties transact across borders, because territorial jurisdictions, which are the ones recognized typically under international law, or defined by reference to geographic coordinates. But notwithstanding the limitations of the concept of of sovereignty, the states remain the key actors in the international community. And following the global financial crisis and the global pandemic, there has been a certain retrenchment to national boundaries with a consequent deglobalization. But there is something more here with digital currencies, and is the concept of cyber sovereignty. What's the cyberspace? The cyberspace is a virtual dimension which adds a new challenge to the classic perimeter problems that characterize financial regulation. That is the borders between regulated and unregulated, and the territorial boundaries. So this third border, which is the cyberspace between the real world and the cyberspace, creates a domain of human interaction that is facilitated and conditioned by digital communication systems. And my last point is that cyber sovereignty adds another challenge in the construct of the legal conception of money. And it's not clear what principle we should apply. In an article again with another author, we suggest that the principle of subsidiarity, which is already applied in the European Union, and which suggests that the authority should be delegated to the institutions which are closest to the people subject to the authority, could provide a third way in the cyberspace, which would provide a different solution somewhere in between the status interventionist model of the state theory of money and the purely libertarian or commercial approach. And my final point concerns accountability. It should be pointed out that any extension in the power of central banks to issue and regulate CBDCs needs to be accompanied by commensurate measures of accountability. This is a fundamental point that one cannot emphasize enough. And the final point is the point that relates to the beginning and goes to a little bit what we're trying to discuss today. And that is that money is a public good, and as such, it requires the public ordering of the monetary and payment system. Thank you very much.
Thank you very much, Rosa. Really interesting consideration you are raising, and we are many regulators and legislative bodies are struggling in to solving these cyberspace, the legal tender issues, legal consequences of that transactions. That's very important, and many countries are looking at the European Union, of course, and other major authorities how to design those. And frankly speaking, MICA was under our consideration and our attention as well. We looked through that even before the final adoption to learn from your experience, because the design will be given, I guess, internationally somewhat. The standard is coming from very important centers of decision making. Now I would pass the floor to Mr. Piero Cipollone, Deputy Governor, Banca d'Italia. Unfortunately, we couldn't have Piero here in Dilijan. Piero, you are totally in this process of digital euro, all these political and professional discussions in the platforms of European Monetary Authority. So please spread light for us what's going on. We can't hear you.
Yes, now you should be able to hear me. Good morning, everybody, and thank you very much for the kind of invitation. I really wanted to be there, but at the last moment, I had some health issue with my family, so I thought it would be more prudent to stay here, and so I couldn't enjoy the social network and the other panel, but you know, that's life. So let me move to my quick talk. So, ladies and gentlemen, esteemed colleague, the program for this panel invites the panelists to reflect on the implication of the observation that, and I am quoting from the program. Despite the apparent increased interest in exploring CBDCs as a viable solution to today's financial inclusion issues, an IMF paper of 2021 found that only 23% of central banks have the legal authority under counter laws to issue CBDC due to monetary sovereignty. And this closed the quote. Now, in this talk, I will argue that this is not a real constraint. Issuing a CBDC is inherently a joint effort of the legislator and the central bank, even in the case the central bank has the power to issue CBDC of its own accord. To explain this better, allow me to take a short detour to explain what money is. The story of how money has developed over time is one of the interplay between technologies, progress, and institutional adaptation. Central bank digital currency is just one further step in this journey. By simultaneously fulfilling the function of unit of account, store of value, and means of payments, money has enabled us to more efficiently produce and allocate goods and services across space and time in increasingly complex economic systems. The extent to which money is effective in performing these three functions hinges on people's trust in it. Thus, in turn, depends on technology and institution. And when I talk about institution, I am referring here mostly to the rule of the game. Any payment technology face a trust problem due to the uncertainty that surround the monetary contract regarding the finality of the payments and the credit risk associated with the liability used as a means of payment. Because of this uncertainty, the effectiveness of a given payment technology is dependent on the existence of institutions and rules that bolster the trust of its users. In modern monetary economies, household and firm use different forms of money interchangeably, provided that they are denominated in the same currency. The existence of a central bank money, for which other means of payments issued by private entities, mainly commercial banks, can be converted at the pair value, provides a common monetary anchor for all private forms of money and gives rise to the single identity of the currency. In fiat monetary system, where money is not backed by a physical asset such as gold, its effective use depends on the general acceptance of a piece of paper or a bits in a digital ledger that cannot be redeemed for anything other than themselves. General acceptance is what ultimately makes them valuable, along with the trust that payments made with them can irrevocably extinguish obligation. All this at the end of the day boils down to the credibility of the central bank. In recent years, the proliferation of the new technology that allow information to be created and transferred and stored in a decentralized and diffused manner, the so-called DLT, the emergence of new type of financial asset based on such technology, crypto asset and stable coins, and the progressive reduction in banknotes as a means of payments have led to a debate about whether central banks should issue a new form of digital currency, CBDC, to preserve in the digital world the monetary anchor role currently performed by cash. Here my detour ends, and I will talk a little bit more about CBDC. CBDC will be able to fulfill these monetary anchor roles as long as it avoids the dual risk of too much or too little success. Rather, central banks should design a CBDC so that it will be a significant means of payments in the economy, capable of coexisting with the current means, namely cash, commercial bank money, and other forms of private money. In the early year of the debate, and Rosa was referring a minute ago to this issue, much of the emphasis was on the too much success side of the risk equation, that is, on the CBDC possible displacing private money. By now, it is clear that this risk can be effectively mitigated because central bankers have at their disposal a large toolkit to prevent this displacement. Limits to CBDC holdings on the sides of the transaction and on the remuneration have all been discussed and proposed. The too little success side is no less important. If the CBDC is not used by the public in performing everyday transactions, it will not be able to fulfill its function as a monetary anchor. To avoid this risk, the CBDC must be designed in such a way to be a trusted means of payments, and therefore both the technology and the institution underpinning the project are of a critical importance. The connection between my comments here and the theme of our panel rests in the fact that political decision makers are in charge of these institutions, while the central bank are responsible for designing the technology underpinning the CBDC. As I explained earlier, a successful CBDC, like all forms of money, needs both a strong technological underpinning, generally a remit of the central bank, and the backing of a set of solid institutions, a responsibilities of the legislator. It is therefore inevitably a shared endeavor of lawmakers and central banks. This clear separation of responsibilities and the cooperation this entails are rooted in the fact that money is a social construct, and issuing a CBDC touches on many aspects of people's life that are beyond the scope of any central bank. I am aware that this proposition might sound a little bit vague. I think that it might help if I illustrate briefly this point by referring to a central feature of CBDC, privacy. Privacy protection is a key feature that is sure to influence people's willingness to use a CBDC. As a matter of fact, it consistently ranks very high among the most desired characteristics of a digital currency in all surveys. Thus, a central bank that wants to encourage a widespread adoption of its digital currency should focus on technology that maximizes privacy, possibly to the point of preserving the anonymity of transactions. However, people are also interested in another feature of payment instruments, such as integrity. You do not want to unwillingly be involved in a money laundering scheme, fraud protection. You would like to be protected from a fraudulent scheme, and the freedom to have many accounts with different institutions. This additional very important feature, which affects people's trust in the system and therefore on their willingness to adopt the new digital currency, cannot be provided without sharing information with the payment scheme manager, thereby compromising to some extent the degree of privacy protection. The optimal combination of the level of such feature ultimately depends on the varying weights attached to each. Different combination of weights result in different solutions. Were the central bank to be the only entity called on to decide, the outcome might be suboptimal, as the preference of the central bank might differ from those of the political body with the responsibility of representing the people, the will of the people. To prevent such a suboptimal result, people's preference need to be appropriately reflected in the solution through the full involvement of the legitimate representative in the process. It's the responsibility of the legislator to set the rule that define the optimal combination. Thus, the need for close cooperation between central bank and the legislator goes beyond the legal question of who is entitled to exercise monetary sovereignty. Issuing a CBDC is much less a technical problem than a very important political decision, as it so deeply involves people's everyday life and goes far beyond the mandate of the central bank. Over the last 4 years of designing the digital euros, the euro system has had to constantly face this question of the political legitimacy of something that goes beyond the formal remit of a central bank. The legal framework for bringing to life the digital euros is the responsibility of the European co-legislator. To prevent any technology-driven decision from being taken, the Eurosystem has undertaken a systemic and continuous dialogue with the European Parliament, the European Commission, and the European Council, and adopted a framework to allow market participants, consumer association, and ordinary citizens to have a voice in the process. On 28 June, as Rosa already said, the European Commission put forward a legislative proposal that regulates the main feature of the digital euros. The proposal endorses most of the technical choices proposed by the Eurosystem, with some important differences. The European legislator and the member states will discuss and define the final regulation to which the Eurosystem will adhere. Thank you very much for listening.
Thank you very much, Piero. I think it's a good moment to have a couple of polls. We would like to check the collective wisdom of the participants, because all of us are hearing and talking about the CBDC implementation, legal issues, technical things. There are many peculiarities, but to look through this a little bit from the helicopter view, what may be the success factors, whether the CBDC may be a reality, a significant thing that will play a role in our financial systems, and starting from the general meaning and why we need that and whether this is possible. So colleagues, please show the polls on the screen, the QRs. Are we ready? Oops. So those who couldn't remember the questions and the question and the options, so what the audience is concerned about, ensuring security and data privacy of digital transactions is the topest thing that we think should be taken into consideration. Focusing on specific use cases, it's another dimension that probably it's a very common view that CBDC probably at least in the beginning may not be something overwhelming and covering everything everywhere. And the third, distinguishing legal structure, what Rosa and Piero were mentioning. We all think that it's getting serious, so the legal ground is of course important, but the next pole, if you can show on the screen, this is very interesting. That frankly, I thought it will be a little, but the poll is continuing. Yeah, it's still open. It's closed. So strangely or surprisingly, the absolute necessity and adoption pace and speed is you believe you are quite optimistical. Whoever voted for that CBDC may be a reality very soon, and it's really needed and solving problems, because my friend Armen was said about CBDC is a solution that tries to find a problem to solve, but probably the implications and further use in the digital economy, it may open up even more opportunities that we don't even think about, that don't even understand its value today. So let me go forward and give the floor to Mr. Byadran Lkhagvasuren, the Governor of Bank of Mongolia. Mr. Governor, please. Yeah.
Can I go?
Yeah, sure. Before Mr. Governor starts, I just follow up to open sources, what Mongolia is trying to do, leapfrog in the area of payments and especially digital transformation. Mr. Governor, please.
Yeah, thank you. Thank you. Okay, thank you very much. Yeah. Ladies and gentlemen, very good afternoon to all of you. First, I would like to congratulate the Central Bank of Armenia for this celebration of the remarkable 30 years of anniversary of the Armenian dirham. And also would like to send our sincere gratitude to the Central Bank of Armenia for your successful organization of this symposium and your warm hospitality. Thank you. Yeah. Of course, it's my pleasure to be here, and I would like to share with you our thoughts on the future of money, and I want to share the Mongolia's old and new payment instruments in this time. I prepared just a speech, then just yesterday's presentation. I just want to have some small presentation to show you something through my presentation. Yeah, we Mongolians have a long history of monetary system. According to historical sources, the coins were used in trade during the Hunnu Empire 2,200 years ago, which inhabited the Eastern Eurasian steppe from the 3rd century before Christ to the late 1st century Anno Domini. Genghis Khan and his successors, they minted gold and silver coins and issued paper money. For instance, in the Yuan dynasty in China, there was a Mongolian dynasty that ruled for only around a century, between 1260 and 1368. You can see that picture, that the paintings in the new building wall. This is the Hovhannes, and just issuing first banknote in the world. It was in 12th century, 1240 something. Yeah. This is there is a people's preparing the chain of the coins. That paper money is based on that coins. The Yuan dynasties in China was a Mongol dynasty that ruled for only around century. The Yuan Empire was the first political regime in the history that pegged paper money to precious metal and the first that deployed the fiat money as a sole legal tender. In 1271, Hovhannes declared paper money was a sole legal tender pegged to the silver. When the yuan government began to print its third paper money, the silver did not play the reserve role. Thus, the monetary system changed to the jure, the fiat money after 1310. The Mongolia's modern banking sector has become a long way since its foundation with the Soviet neighbors' help. In 1924, the Mongol bank opened with a single branch as a first state bank in June 1924. As it's the foundation of today's Bank of Mongolia, we count our bank's history since then. Yeah. After its establishment, the bank issued its first banknote in 1925 and called its national currency Mongolian tugrik. At that time, banknotes were backed by precious metals and commodities. For instance, one tugrik, valued as the 999 fine silver coin that weighed 18 grams, was released into currency circulation. In subsequent years, new designs and denominations were introduced and security features were enhanced to prevent counterfeiting. The technology's evolution has revolutionized how we handle transactions and payments. The transition from the traditional paper money to digital currency and electronic payment instruments has brought unprecedented convenience and efficiency to our financial interactions. It's impressive to see how private entities have taken the initiative to develop and offer these innovative solutions, enabling us to conduct transactions seamlessly regardless of our geographical location. You already know that Mongolia, we have two giant neighbors. In the north side we have Russia, in the south side we have China. Today's internet-based, electronic-based, digital-based solutions are helped us a lot to make a trade with our third neighbors. Mongolia's introduction for instant fund transfer services back in 2014 is a prime example of how forward-thinking payment systems can significantly benefit a nation's economy and people. This kind of service enhances domestic transactions and contributes to the overall financial inclusion of individuals and businesses. Regarding financial inclusion in Mongolia, the share of unbanked adults is small. There are no gender gaps in account ownership, and the use of accounts are relatively high in Mongolia. According to Global Findex database of World Bank, 98% of adults own financial institution account, and the share of adult women who hold an account is 99%. These financial inclusion indicators are highest in the lower middle income and East Asia and Pacific regions. In recent years, mobile banking has come to play a crucial role in spreading financial inclusion in Mongolia. As of end of 2022, about 95% of bank payments have been made through non-cash transactions. The rise of cryptocurrencies and other digital currencies, coupled with the advancements in the distributed ledger technology, has significantly changed financial landscape. Understandably, the central banks worldwide closely monitor the rise of the cryptocurrencies, stable coins, and other digital payment technologies. The adoption of these technologies, while offering many benefits, also presents challenges related to monetary policy control, financial stability, and overall regulatory oversight. Yesterday we already discussed about the role of the central bank, the monetary policy or financial stability. The Central Bank of Mongolia, we have a kind of unique concentration of the policy. We are implementing monetary policy. Also, another duty is the financial sector stability. We conducting supervision on our banking system. Also, Central Bank, we are, according to law, we are responsible to organize payment system in Mongolia. The central banks are right to concerned about the maintaining the authority over monetary policy and the safety of national payment systems. In response to these challenges, many central banks are exploring the concept of the central bank digital currency, CBDC. Therefore, the Bank of Mongolia is taking proactive steps to explore the potential benefits of CBDC through a dedicated project. This initiative reflects forward-thinking approach to adapting to the changing landscape of payments and finance. We see that this effort has potential to provide an additional payment instrument and infrastructure for public in an environment of declining cash usage. Our institution has explored CBDC prototypes and the associated technologies for 2 years. Throughout this journey, we have examined both decentralized models that utilize the blockchain and distributed ledger systems, and also centralized systems. The insights gained from our research, we have highlighted certain limitations of decentralized models in terms of the agility for payment applications. On the other hand, centralized systems are similar to the existing real-time payment mechanism like ACH, automatic clearinghouse, and RTGS, real-time gross settlement, in for high-value payments. Currently, we are closely tracking the path of many CBDCs projects and are committed to advance our journey. For example, another neighbor, China, is already introducing CBDCs, but we carefully watching that systems. The CBDC, which is issued by the Central Bank of PBOC, Central Bank of China, based on application, special application, also competing with other payment systems like WeChat, Alipay. That's why Central Bank side, from Mongolia, we are carefully watching how it works, how it competing with the private sector's services. Yeah. Finally, I want to emphasize that the design of money has potential subsequences that concern in all of society. Those central banks must collaborate and share their experiences in the shaping the future of money with the digital era. I hope today's discussion will advance the frontier one step ahead. And thank you very much. I will finish my speech here. Then, if you have any special questions, I will try answer your questions.
Thank you, Mr. Governor. I'm sure we'll have follow-up questions regarding the experience of Mongolia, and very interesting presentation, and the format starting from the ancient ages till now to digital world. Impressive long history of the country. Thank you very much. And last but not least, Salvador Perez-Galindo, Visa Corporation, head of government relations in CEMEA region. Salvador, you are the one who are from private sector. You are profit chasing company. You are not too much interested in why and what is the meaning of all this transformation is happening. You are focused, I guess, on providing services to your customers and having your big niche in the world. And we see this all transformation, and probably your company has your own answer to those questions and your own big initiatives. So please go ahead.
Thank you, Hovhannes. First of all, big responsibility being the only private sector company here speaking, but I have our colleagues here in the audience as well. And a couple of comments before I start with the presentation. First, congratulate the Central Bank of Armenia for this wonderful gathering. Very comprehensive, policymakers, scholars, academics, and also allowing the private sector to be present here. It's really an honor, a privilege. And secondly, also to your point, I don't know if we have all the answers. We share a lot of the questions, but at least we can bring additional questions that might not be the traditional ones for policymakers or scholars. And in this case, on the future of money, in the poll that you brought, I noticed that the question about use cases is recognized as an important one. It's not a question only of having the technology, which we all agree it's already there, distributed ledger technology, or putting together the regulatory framework, that it's work in progress, it's challenging, as we heard from our European colleagues. But it's also the angle that I'm going to bring in my presentation, which might sound more practical, but it's also very important, which is the user experience, right? What do we want to solve for? How easy is to convince a consumer to use a CBDC versus a crypto versus a card payment versus instant payments? Space is getting crowded and crowded. So allow me to focus, because the title of the presentation is obviously CBDCs, just recap on something that was already mentioned before, which is the evolution of digital currencies in the last 15 years or so. I won't go into details because it's something that it was already raised. Cryptocurrency started obviously disrupting the space back in 2008, in the midst of the financial crisis, also in the midst of what has been called also the emergency of Web 3.0, which is the potential of the internet to really bring a more innovative and disruptive experience for users, bringing AI, machine learning, and a whole set of new user experiences. Subsequently, stable coins, right, which we can simplify as saying cryptocurrencies linked to fiat currency. Also triggered by what Professor Rosa mentioned about Libra Diem, right? That was a proposal of a stable coin, and it accelerated the discussion, the emergence of more stable coins. CBDCs, which I would say is the public policy response to these developments. The private sector started with these developments. No surprise, there has to be a policy response. The Libra situation clearly triggered, we all know, a more intense debate. And now we're also discussing about bank coins, tokenized bank deposits that would supplement wholesale CBDC, could add another layer of efficiency in cross-border payments, bringing a new set of use cases at interbank dimension. I think the discussion here is more focused on retail, so I will focus my comments on stable coins and CBDCs. Very briefly, this graph shows the evolution of USDC, which is one of several stable coins. It's about 30% of the US-linked stable coins. And Visa, let me reiterate, Visa settles in fiat currency around the world. We're very proud of settling in drams, being a partner of CVA. Apple Pay, what we call tokenized transactions, which are digital transactions happening on the phone, are settled in drams. But we are testing the need to settle in stable coins as well, because we realize That's a functionality that payment systems have to have. And I just want to put in context this graph and how the growth is steady. Some falls, particularly in what some have called the winter of cryptocurrencies, but it will come back. These are cycles, and this is a reality that all policymakers are aware of, that in Europe with MiCA, what Professor Rosa mentioned, will also provide a better and clear regulatory framework for stable coins. But moving to CBDCs, which I think is more the focus of this session, this is a map. It's part of a global tracker. It's a bit of a congested slide, and by no means is a comprehensive assessment of CBDCs. I just want to highlight what it was also revealed in the poll, which is a divided opinion, and the verdict is still at a very early stages on how fast we will see CBDCs being implemented around the world. I highlight these cases for obvious reasons, and I won't comment on the European experience. There are a lot of experts who have already commented on that. I will just contrast the Nigerian experience, and I will bring some data that we collected this year as one of the early adopters and some of the lessons learned for implementing a successful CBDC. I will contrast it with the case of Kenya. For those of you who are not aware, Kenya carried out a very extensive public consultation, more than a year. And in June, they basically decided that they were not going to pursue a CBDC, that it's not a priority in the short and medium term. Probably they were looking also at the Nigerian experience, and obviously in Kenya, financial inclusion, mobile payments have had their own path of development. India and Kazakhstan are very interesting. The Deputy Governor of National Bank of Kazakhstan already mentioned what they're doing. We're very keen in collaborating with them for the reasons that I will mention later in the next slides. And India is moving very fast. India is probably, as we all know, in the forefront of a lot of digital finance innovation. And in addition to digital public infrastructure, what they built with UPI, they're also moving very fast with the digital rupee. I think they have already close to 1 million users in 14 cities and about 300,000 merchant locations. So moving very fast as well. It's a case that is worth following very closely. Now, going to Nigeria, because this is what we want to share with you. This is not us, this is the IMF assessment that was released in May this year. It's an interesting assessment because there's not a lot of information about eNaira. I was double checking if the official eNaira website is now releasing statistics, and I couldn't find it. So these are the statistics of the first year of implementation. And the results were not encouraging, right? Less than 1 million wallets downloaded, so you probably cannot see all the statistics, but this is in the IMF report. Monthly transactions, very flat, some peaks, but overall there was no traction from users. So probably what the Nigerian case shows is you can have the technology, you can have the political will, appetite, you solve for the legal and regulatory framework, but if at the end consumers and merchants don't use it, doesn't have viability. And why they didn't adopt it. These are partial results based on a survey we conducted in March, includes consumers and merchants. And these are we ask basically which of the below describes the extent, to what extent you're aware of eNaira and the top three reasons that prevented you from using it. And depends on the type of user. These are consumers. And Nigeria, as you probably know, is very active with cryptocurrencies. So you have a segment of the population who is already well aware of cryptocurrencies. And that's the one in the farther right hand of the slide. For them, the main reason not to use it was because they don't see a better value proposition than cryptocurrencies. Others who own it in the past or who never owned digital currency would have a slightly different approach. But in general, and the interesting one is those who didn't have any prior experience, they didn't use it because there was no wide acceptance of the INAIRA. There were other comments, not a lot of information, and a lot of mistrust on the central bank, unfortunately. So it's a very unique case, but what I want to emphasize is the importance of ensuring there's appropriate consumer experience. Use cases that were mentioned in the poll. If we don't have that, it's going to be hard to get traction for CBDCs. And this can be summarized in these 3 findings from the Nigerian survey that we conducted. By far is what I mentioned, the lack of what we call acceptance, merchant acceptance, lack of appropriate education, awareness, and in general, not very friendly for users, lack of usability, not addressing specific needs, cross-border payments. Initially, only the financially included population could download the app, so even financially excluded segments of the population couldn't have access to this. What we're doing, and you might be wondering why I am talking about CBDCs if we are a payment card network. For us, the future of payments is really the future of interoperability. For the reasons I was mentioning before, the space is getting very crowded, and the consumer and the merchant would have the last word, right? Who will prevail? The competition is fierce. We need to be prepared to provide the best consumer and merchant experience. A merchant probably wants to have a POS that accepts all possible means of payments, all brands, all rails. And that's where we want to participate, where we want to facilitate and provide that interoperability. These are just examples of use cases that we have been presenting in hackathons in Singapore with the Central Bank of Brazil, that we played, just to give you an idea, we play with the idea of using agro tokens. These are tokens used for agricultural crops. You tokenize your production, and those tokens can be used for commercial transactions for producers. So we are providing the means of commercializing as well those crops through a token to be able to transact and use it as a means of payment. And in Hong Kong, we are, as we speak, in another experience with 2 banks, including HSBC, which would be a tokenized deposit experience. So this is where we're coming from. This is the value, the thought leadership that we want to continue bringing to the table. And just to conclude, these are the 3 main takeaways. I hope I was clear enough on why, and that's probably the question that was not posed in the poll. It's so important to look at the user experience. That's where the private sector comes, right? That's why it's so important that all of you who are really thinking about CBDCs bring to the table all the private sector players that we jointly discuss, just as we're doing in Kazakhstan. Kudos to the National Bank and to the consultants who are supporting them, because it's really a very open and inclusive approach on how to ensure a CBDC gains transaction. So with that, I conclude my intervention, and I look forward to the discussion. Thank you.
Thank you very much, Salvador. Very interesting, really. And as long as you are a competitive private sector company, I would like to emphasize a little bit on that word of competition. We see a little bit competition in private money, public money, between different jurisdictions, the regulatory arbitrage that may happen in this area, very many different initiatives. So, and competition for seigniorage, competition for payments, as a business. So it's really, the world is quite open. The Nigerian case, people are answering that I have another alternative. Of course, it's also a matter of legislation, what is legal tender and how you can legally pay and use specific money. But you have to bring your proposal to the end customers, end user, in a way that is useful for them, not that is the best probably for monetary policy. Maybe it's very nice for us as a central bankers, but when people don't need that, it's not for us at the end of the day. So the floor is open for the questions. John, please, the micro to John.
In listening to the talks, this session and the one before, I'm struck by how enthusiastic these countries are in embracing new digital technology and payment systems, and very encompassing how this is seen. When I've been in similar events in Europe, it's always very narrow, always problems. The emphasis on what we can't do this, we can't do that, it's limited, there are all these problems. And here we see vision. And are any of the panelists willing to elaborate on why we have this, I guess, movement towards backwards payment system and negativity in Europe compared to what we are seeing reflected in this session?
Thank you, John. We'll collect a couple of questions. Federico?
I think this is a question for Salvador. A natural candidate to issue money are the marketplaces, say Amazon in the US. You know, they have a lot of people, they transact, they buy and sell things in the platform. And I'm wondering if there's a way for, if a central bank would want to stop that, if they can really do that, because it's kind of, it could be like another good, no? That people are just using for trading. So if you could have some reflection on that.
Very good. Others? Before going further, let's cover these two interesting questions about why and whether we are really optimistic and we see real implications. In Amazon's case, the tokens are incredible. They are not that much invisible, but Amazon is a big marketplace and they made its own economy global, by the way, without even naming it currency or money, but it's happening there. Colleagues from Zoom or others who would like to go first? Salvador?
Start first. Thank you, Gordon. Let me start with the easier one, Federico's point. Thank you for reminding me, because I didn't mention PayPal. And you might be aware that on August 3rd, PayPal announced its stablecoin. It's backed by US Treasuries. And PayPal is a marketplace. So to your point, they are going the route of stablecoins, in addition to their own digital wallet, right? So the response is they're looking for everything to not only increase their visibility, their presence, but be very relevant for all type of use cases. Amazon issues card. Obviously, it's one of our biggest partner. I have obviously, as you can imagine, it's a Visa Amazon card. So a lot of the transactions happening in the portal are through cards. And having what we call an open loop card is more powerful for them because it secures the interoperability. That card can go anywhere. So from a business case perspective, it's very clear for them the value. Now, I'm not so sure how that would include a CBDC, right? The CBDC, to be relevant, has to be accepted in a marketplace. So let me use your question to emphasize the importance that CBDCs have to have for e-commerce. Because if you cannot have that experience, the user probably won't be that attracted, and e-commerce, as we know, is m-commerce, right? It's through the mobile. So this is another example where that consumer-friendly interface is key for whomever. That's the lesson that we have learned from more than 60 years of operation. If we don't adapt to the consumer needs, and in every, and now I will address the second question, in every market it's different appetite to test new technologies. In many countries we still have cash on delivery for e-commerce, which doesn't make any sense. But guess what? Marketplaces need to adapt to cash, right? So, but thank you for the question, because it's very relevant. On Europe, hard to have a definite question. I think it's similar to the discussion in the US, in developed countries where you really have financial inclusion. You have solved for many of the other challenges that developing countries are still looking at. But it's hard for me to tell why, particularly the consumer, the society seems to be quite divided around CBDC. And well, Christine Lagarde brought also a political argument on CBDCs, right? Which is valid. Right? You want to create alternatives, you want to create more resilience to the payment system. But if anything, Europe provides another example of the consumer is king. At the end of the day, beyond the political process, if they don't want to use it, and we have struggled with credit cards in Europe as well. It's a very specific situation. Debit, consumers in general don't like credit, so that's a guess, but apologies, I don't have a better answer. Probably the governor has one.
Mr. Governor?
Hello? Yeah. Okay. Let me answer the two questions. It's from my point of view. I'm the practitioner. I'm working in the life, you know. The central bank side, central bank is a regulator. The regulator always follows the law. What kind of law exists in your market, you know? For example, in 2018, we draft the law of the payment system. Then we submitted to the parliament. Parliament was approved it. Then, according to that new law, we allowing the stable coin can exist in the market. Let me just give the example. We have for the mobile phone provider. One of them is Mobicom, the first one. The Mobicom issued the kind of stable coin. According to law, we are allowing them, you have a kind of digital coin, the one digital coin. The name of the coin is MonPay. Then we are allowing them, you should have the back of that digital coin, 1 tugrik, that's the Mongolian currency. Then how much money, you know, are you issuing the digital currency? You have to back it, the real money there. That's why now that all user of this Mobicom using that digital currency. It's transferring each other, you know, just transferring each other. But that company need to have a account every bank in Mongolia, because one of the bank customers using the mobile phone, then he has an account in other bank, then when he's transfer the currency, I mean making payment, then that money should come from their bank account to another bank account. Then now it's working very well. That's the one. Second issue is you raised the issue of the Amazon. There's so many, I mean, customers are buying goods from Amazon, but those payments are went through the banks, you know. We have a Visa internationally in Mongolia. We have a MasterCard in Mongolia. We have a UnionPay, Chinese provider in Mongolia. Those payment providers are helping the customers to buying goods. All the transactions went through their network. That's why, for example, just recently, one of very famous correspondent, I mean journalist, came to Mongolia, and he just showing us, I mean, just he's in socially he informed that he has a Apple phone, and also he put the card account to the phone as a tokenized the Apple Pay. Then he bought coffee in Mongolia. The coffee shop sold the coffee through that Apple Pay. But in Mongolia, we don't have Apple Pay network. But he understood that Apple Pay works in Mongolia, but actually is not working in Mongolia. But he has maybe the MasterCard account or Amex American Express account in his phone, but the POS machine is already read it, and transaction was successfully made it. That's why now Mongolians are preparing lots of the contents. They're willing to sell to the world. That's why all the customers asking us, why is central bank not helping them to connect Google Pay or Apple Pay and also PayPal? The PayPal already exists in Mongolia some years ago, but they lost some. They lost, the operation in Mongolia because according to PayPal's rule, they set up the exchange rate. They change the exchange rate monthly basis, but Mongolian economy is not waiting for. The exchange rate fluctuating so much, they lost because of this fluctuation. Yeah. Now they already not existing in Mongolia, but we are always asking them, why don't you come back in Mongolia? Then Central Bank said we wants to help you to manage the fluctuation of the exchange rate. That's the thing. The second question, the payment system developing in Mongolia very well because of our Central Bank participation. We are developing infrastructure for banks and also for startups, non-bank financial institutions who are providing those technologies. And we are bringing to our electronic payment system. We develop our ecosystem. Anyone who wants to offer the products, that products can be useful for the customers, we are allowing them to connect them. That's why now in Mongolia, our landscape is huge, 1.5 million square, only 3.6 million people live in. There's a big distance between. That's why some people who's living in the mountain area, they cannot access the bank account, but through these providers, they already have can access the bank accounts. For example, in this summer, I went to countryside and I visited to herds people. Then I'm buying some goods, the milk production from them. The lady who's is preparing the milk products, and she gave me just bank account. Then I have a mobile phone. She has a mobile phone. Then just after 1 second, she said, "Oh, I got it. I got your payment. Then you can buy this milk. That's now it's very good developed in Mongolia. That's why my answer is, if government is preparing the ecosystem of payment ecosystem and infrastructure, then the private sector can play on the infrastructure. That's why I would say if the central bank or the government side are helping to private sector to develop the infrastructure for payments, then any solution, any applications, any new technology systems can work on that system. Then the Europe is the huge region, so many developed country in there. Maybe we can find some solutions there. Yeah, that would be my answer. Yeah, thank you. Yeah.
Can you hear me? Yeah, Rosa, please.
Yes, I just wanted to add very briefly, conscious of time, that the latter question goes back to something which has always been an important issue when talking about money, and that there is a societal theory of money, in which money is what the market wants money to be, and there is a state theory of money. And I think that both theories are very relevant when one talks about the digital opportunities. We have still a state theory of money with CBDCs, but we have societal theory of money with the advent of stable coins and cryptocurrencies. When it comes to payments, and I second what the other speaker said, we are really entering into a huge innovative field, and the field of shadow payments continues to expand and expand. But after all, payment is one of the functions of money. So the debate about money is still different from the debate about payment. As regards the enthusiasm that exists in other parts of the world, including Armenia, I mean, one cannot ignore also, in addition to the financial inclusion, the remittances, the extraordinary influence of the US dollar, and also the use of the possibility of using the US dollar and the reserve system and the SWIFT system for payments as a sanction, what has been called the weaponization of finance. So there has been, of course, an interest in other parts of the world about the opportunities to develop alternatives to the US dollar. And for all these reasons, financial inclusion, weaponization of finance, and others, there is, in my opinion, a greater enthusiasm in other parts of the world, from China to the Middle East to many other countries, in the opportunities that the digital revolution offers. Thank you.
Thank you, Rosa. Really another important viewpoint about the political part. What may be the even hidden reason of going through these alternative ways of digital money, etc. Piero, would you like to intervene?
Yeah, no, I just want to comment on this issue about enthusiasm in Europe. Maybe there is no, I'm not completely sure that this is true. It depends on who you talk to. Merchant seems to be very, very interested in digital euros for a price issue. However, despite the lack of enthusiasm, I cannot refrain from noticing that Europe, as one of the most advanced projects in CBDC, we have a legislative proposal before us, and we are discussing. The technical development is pretty much advanced, and with a original solution, because the complexity in Europe is much higher, because you have to deal with 20 countries with different legislation, with different preferences. So it seems to me that despite the possible lack of enthusiasm, which again, I am not sure is there, depend on who you talk to, certainly some PSP, some incumbent have a large voice in suggesting that, there is no much need of a CBDC. But when you talk to people in the surveys and to merchants, you see a completely different enthusiasm. And then depend on the countries, on the legacy system that they have. So maybe there is a lack of enthusiasm. Again, it depends on who you talk to. And it seems to me that despite this lack of enthusiasm, the political will is there and the technical skill is there. So I am pretty much sure that in due time in Europe, we will see a robust CBDC issuing from the Euro system.
Thank you very much. Yes, Salvador.
Just one quick comment to Professor Rosa. I totally agree that payments and money are different, but one of the three key attributes of money has to be a means of exchange, in addition to store value and unit of account. If a CBDC is not providing the means of exchange for the population, probably it's not fulfilling the promise of money. That's all.
Yeah. Thank you, Salvador. We are finishing. We are approaching our time limit, and thank you very much for all panelists and audience and for the questions. Today we didn't went too much into different options of design choices of how CBDC and other digital currencies may work. it is wallet, it is token, every technology is there. What we all consistently hear, that technology is not an issue. The problem is legal. The problem is a consensus between market players and way how this technology reach every person. You design something fantastic, but it's not working. You design something very simple, it's working. So it's about political will, it's about maybe lobbying from incumbent financial institutions and scheme. There is lots of sunk costs of payment infrastructure, and interests are big and sometimes very diverse, very controversial. So we probably, as Salvador said, we got more questions than answers at the end of this short session. But again, it was sort of food for thought for all of us in designing the legislation, in designing the strategy towards going forward in this new era of money. Thank you very much, all of you, and let's have a lunch. Before that, a very slow. Thank you very much. A very small but technical announcement. Haydi, Carlos. Okay, the problem is solved.